Welcome to FXTech. This is your weekly analysis for the USD/CHF pair, covering December 15th to 19th, 2025. This week, the currency pair was caught in a tug-of-war between a hawkish Fed, a vigilant Swiss national bank, and surprising U.S. inflation data. The market closed the week with a slight gain for the dollar, but the price action reveals a complex battleground. We'll dissect the key news events, break down the technical consensus from 5 leading sources, and provide actionable trading strategies for the short and midterm. Whether you're a range trader or a trend follower, this report will give you the critical levels and strategic insights you need to navigate the USD/CHF market in the coming weeks. Let's get started. Let's look at the numbers. The USD/CHF ended the week at 0.80466, marking a modest weekly gain of 0.14%. However, this small change hides significant volatility. The pair saw a high of 0.8084 and a low of 0.7923, carving out a 161 pip range. This price action reflects a market in consolidation, trapped within a 5-month range. The key takeaway is the market's indecision. Despite strong fundamental drivers, neither bulls nor bears could establish control. The pair tested both upper and lower boundaries of its recent range, but ultimately failed to break out, closing near its weekly open. This sets the stage for a potentially explosive move as we head into the year-end. The Federal Reserve's decision was the week's main event. The Fed delivered a 25 basis point rate cut, but the details revealed a deeply divided committee. The 9-3 vote split, with 3 officials dissenting, was a hawkish surprise. These dissenters argued that inflation remains too high to justify further easing. Furthermore, the Fed's forward guidance signaled a tougher road ahead, projecting fewer rate cuts in 2026 than the market had priced in. This hawkish tone provided strong underlying support for the U.S. dollar, preventing a significant sell-off and reinforcing the positive carry trade that favors holding the dollar over the Swiss franc. This policy divergence is a key bullish factor for USD/CHF. Not to be outdone, the Swiss National Bank made its presence felt. While holding its policy rate at 0.00% as expected, the SNB issued a powerful warning. Chairman Martin Schlegel explicitly stated the central bank remains willing to be active in the foreign exchange market as necessary. This was a clear signal to the market that the SNB will not tolerate excessive franc strength. The market reacted instantly, with USD/CHF plunging 0.65% after failing at the 0.8001 resistance level. This action effectively established a hard floor for the pair around the 0.7900 level, creating a strong support zone that traders must respect in the weeks ahead. Later in the week, U.S. inflation data threw another curveball. The Consumer Price Index came in at 2.7% year-over-year, a significant miss from the 3.1% that was expected. This marked a notable deceleration from the previous month's 3.0% reading. Initially, the softer inflation print caused the U.S. dollar to weaken, and U.S. dollar Swiss franc dipped to 0.7940. However, the dollar quickly recovered, with the pair stabilizing around 0.7957. This resilience shows that the market is looking beyond single data points, with the Fed's hawkish stance and the SNB's intervention floor providing stronger directional cues. The market's muted reaction suggests the bar for a sustained dollar sell-off is very high. When we synthesize the analysis from 5 major sources, a clear picture of indecision emerges. TradingView's indicators are firmly neutral. Investing Live points to a bearish rejection at the key 0.8000 resistance level. Action Forex describes the market as tightly range-bound. Forex.com highlights the 5-month consolidation, noting that a breakout above 0.8153 is needed for a bullish trend. Finally, Daily Forex maintains a slight bullish bias, citing the SNB's intervention floor and the positive carry trade. The overall consensus is clear. The market is in a neutral, range-bound state, coiling for its next major move. This lack of a unified directional view underscores the importance of the key technical levels we'll discuss next. Understanding the key levels is crucial in this market. At the top, we have major breakout resistance at 0.8153, which is the 200-day moving average. A sustained break above this level would signal a major trend reversal. Closer in, immediate resistance sits at the psychological 0.8000 mark, where the pair was recently rejected. To the downside, immediate support is found at the 0.7900 level, which is the SNB's perceived intervention floor. This is a strong buying zone. Below that, the critical range low is at 0.7882. A break below this level would signal a resumption of the prior downtrend. These four levels define the current battlefield for USD CHF. For the next 1 to 2 weeks, our primary scenario, with a 60% probability, is for neutral consolidation to continue. We expect the pair to remain trapped between the 0.7900 support and the 0.8000 resistance, especially given the light holiday liquidity. A bullish breakout above 0.8000 has a 25% probability and would require a significant catalyst, targeting the 0.8050 to 0.8084 area. A bearish breakdown below the 0.7900 floor is the least likely scenario, with a 15% probability due to the strong SNB intervention threat. The short-term strategy is to trade the range, buying dips and selling rallies, while respecting the boundaries. Looking out over the next 1 to 3 months, the fundamental bias favors the upside. The widening interest rate differential between the US and Switzerland, combined with the SNB's intervention threat, supports a stronger dollar. Our primary scenario, with a 45% probability, is a gradual grind higher within an extended range, targeting the 0.8100 to 0.8200 area. A more aggressive bullish breakout, with a 30% probability, could see the pair target 0.8350. A bearish breakdown, with a 25% probability, would require a significant deterioration in the US economy. The balance of probabilities suggests that the path of least resistance is gradually higher over the medium term. Here are the actionable strategies. For range traders, the plan is to buy in the 0.7900 to 0.7920 zone, with a stop loss below 0.7880. The target for these long positions would be the 0.7990 to 0.8000 area. For trend traders, patience is key. Wait for a confirmed daily close above 0.8000 and ideally a weekly close above 0.8050 before establishing long positions. The target for a breakout would be 0.8200 and higher. For all strategies, disciplined risk management is paramount. Use a position size of 1 to 2% of your capital and be aware of event risk. The 5-month consolidation is building energy, and while the balance favors an upside resolution, managing risk is the top priority.